Getting started with small-scale investing. 1. Introduction. In today's economy, investing has become an important means for many to pursue financial freedom and accumulate wealth. However, for most novice investors, the substantial amount required for investment often presents a daunting barrier. This makes small-scale investing an extremely attractive option, not only lowering the entry threshold, but also providing an avenue for ordinary people to achieve financial growth. The significance of small-scale investing lies not only in opening the door to investment for those with limited funds, but also in embodying the principle of gradual accumulation. Through consistent small investments, even seemingly insignificant amounts can lead to significant wealth growth over time. This is particularly important for those seeking to improve their financial situation and achieve long-term financial goals through investing. Moreover, small-scale investing also serves an educational purpose, helping investors learn investment knowledge and skills through practical experience, gradually developing their understanding of the market and their own investment style. This learning and accumulation are invaluable for novice investors, laying a solid foundation for future investment decisions. However, small-scale investing is not without risks. Market volatility means that even small investments are susceptible to losses. Therefore, when engaging in small-scale investing, investors need to carefully assess their risk tolerance and adopt appropriate risk management strategies. Additionally, due to the smaller investment amounts, investors need to maintain realistic expectations, understanding that the returns on small-scale investments may take longer to materialize. In conclusion, small-scale investing offers a viable path for a wide range of investors to achieve financial goals. Through proper planning and consistent investment, even small amounts of capital can wield significant power over the long term. Therefore, this video aims to delve into the strategies and methods of small-scale investing, helping investors understand how to effectively engage in small-scale investing and achieve their financial growth goals. 2. Defining small-scale investing. Small-scale investing, as the name suggests, refers to investment activities carried out with relatively low amounts of money. It allows even investors with limited funds to participate in financial markets such as stocks, bonds, and funds. From a logical standpoint, the basic concept of small-scale investing not only encompasses the diversity of investment methods, but also includes its strategic significance and operational methods in financial planning. Feasibility of small-scale investing. Firstly, advancements in technology and innovation in financial markets have provided a broad platform for small-scale investing. In the past, high transaction costs and minimum trade requirements often excluded small-scale investors. However, with the rise of online trading platforms and significant reductions in transaction costs, even funds as small as tens or hundreds of dollars can be invested, greatly reducing the market entry barrier. Strategic significance of small-scale investing. Secondly, from the perspective of long-term investment, small-scale investing can gradually accumulate into significant wealth. The principle behind this is the compounding effect, where invested funds generate returns over time, and these returns, when reinvested, generate new returns. Therefore, even with small-scale investments, as long as they are consistently and strategically invested, the accumulated wealth may exceed expectations in the end. Operational methods of small-scale investing. In terms of operational methods, small-scale investors should focus on diversification and regular investment. Diversification can reduce risk by investing in different types of financial products, such as a combination of stocks, bonds, and funds. Regular investment, such as dollar-cost averaging, can reduce the impact of market fluctuations on investment decisions by purchasing at different times, lowering the average purchase cost, and thereby improving the overall effectiveness of the investment. Risk management in small-scale investing. It's worth noting that even with small-scale investing, risk management is crucial. Investors need to choose appropriate investment products based on their risk tolerance and be psychologically prepared for long-term investment, avoiding making irrational investment decisions due to short-term market fluctuations. In summary, small-scale investing provides a feasible path for a wide range of investors to achieve financial goals. By understanding the basic concepts and operational methods of small-scale investing, combined with appropriate risk management strategies, investors can achieve significant financial growth from small beginnings. 3. Main channels for small-scale investing. In the realm of small-scale investing, investors have various options, with the primary ones being stocks, bonds, and funds. Each investment channel has its unique characteristics and risks, so choosing the most suitable one is crucial for achieving investment goals. Stock investing. Stocks are a common investment avenue where investors buy a small portion of a company's ownership and potentially gain capital appreciation and dividend income as the company grows. For small-scale investors, entering the stock market has become more accessible, with many online trading platforms offering low-cost trading options, even allowing fractional share purchases. While stock investing offers higher potential returns, it also comes with higher risks, especially from market fluctuations affecting stock prices. Therefore, small-scale investors should conduct thorough market research and consider diversification to mitigate risks when choosing stock investments. Bond investing. Bonds are debt securities issued by governments or corporations to raise funds, with investors becoming creditors entitled to future returns of principal and interest. Compared to stocks, bonds are generally seen as a more stable investment option with lower risks, suitable for small-scale investors with lower risk tolerance. However, bond investments typically offer lower returns and may be affected by changes in interest rates. Therefore, when choosing bonds, small-scale investors need to consider the interest rate environment and evaluate the risk and return characteristics of different types of bonds, such as government bonds and corporate bonds. Fund investing. Funds pool funds from multiple investors and are managed by professional fund managers. Funds can invest in various assets such as stocks, bonds, and money market instruments, including both actively managed funds and passive index tracking funds like index funds. For small-scale investors, the biggest advantage of fund investing is the ability to diversify investment risks through professional management and participate in a broader market at relatively lower costs. Especially for those lacking time and expertise to conduct individual stock analysis, funds offer a convenient investment avenue. In conclusion, small-scale investors should choose investment channels based on their financial goals, risk tolerance, and market understanding. Whether selecting stocks, bonds, or funds, the key lies in conducting thorough research, making reasonable plans, and maintaining patience and discipline for long-term investment. 4. Small-scale investment strategies. In the practice of small-scale investing, adopting appropriate investment strategies is crucial for achieving financial goals. Let's discuss several strategies suitable for small-scale investors from an explanatory perspective. Dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount at regular intervals in a specific asset. Its advantage lies in reducing the impact of market fluctuations. For small-scale investors, this strategy not only relieves the pressure of timing the market, but also allows for accumulating more assets under different market conditions, beneficial for achieving the average cost effect in the long term. Diversification. Diversification means spreading your funds across different types of investment products to reduce risk. For small-scale investors, diversifying investments among stocks, bonds, funds, and other asset classes can effectively lower the risk of loss from a single investment. Additionally, diversification helps in situations where poor performance in one asset class can be offset by better performance in others, protecting the overall value of the investment portfolio. Long-term holding strategy. The long-term holding strategy emphasizes holding onto investment products until reaching investment goals. For small-scale investors, long-term holding maximizes the compounding effect, where investment returns generate new returns when reinvested. Furthermore, long-term holding reduces costs associated with frequent trading, such as trading fees and tax burdens, and helps reduce the impact of short-term market fluctuations on investment outcomes. Cost control. For small-scale investors, controlling various costs during the investment process is key to improving investment efficiency. This includes choosing platforms with low trading fees, paying attention to management fees of investment products and other possible hidden costs. Low-cost investing not only directly increases investment returns, but also accumulates into significant asset appreciation over the long term. In summary, for small-scale investors, adopting suitable investment strategies is crucial. By implementing strategies such as dollar-cost averaging, diversifying investment portfolios, long-term holding, and emphasizing cost control, small-scale investors can effectively manage and diversify risks while achieving stable financial growth in the long run. 5. Risk management and setting realistic expectations. In small-scale investing, managing risks and setting reasonable expectations are crucial for investment success. Understanding and adopting effective risk management strategies while setting realistic investment goals and expectations are essential for avoiding unnecessary losses and achieving long-term investment growth. Importance of risk management. Firstly, risk management involves identifying, assessing, and controlling the risks that may arise during the investment process to minimize the likelihood of losses. For small-scale investors, risk management includes selecting investment products that match their risk tolerance and diversifying investments to reduce the risk from any single investment. Risk assessment. When conducting risk assessment, investors should consider various factors such as market risk, credit risk, and interest rate risk. By understanding these risk factors, investors can make wiser choices of investment channels and products and develop investment strategies based on their risk tolerance. Diversification. Diversification is a key strategy in risk management. By investing funds in different types of assets, such as stocks, bonds, funds, companies in different industries, or even markets in different countries, specific investment risks can be effectively diversified. For small-scale investors, even with limited funds, diversification can be achieved through investment in diversified funds or ETFs. Setting realistic expectations. In addition to risk management, setting realistic investment expectations is equally important. Small-scale investors should recognize that investment returns usually correlate with risk, where high returns often come with high risk. Therefore, investors should set reasonable profit goals based on their risk tolerance, avoiding the pursuit of unrealistic high returns to prevent unexpected losses. Long-term perspective. Lastly, small-scale investors should maintain a long-term investment perspective. Short-term market fluctuations are inevitable, but in the long run, markets typically show an upward trend. Therefore, maintaining patience, adhering to long-term investment strategies, and not easily changing investment decisions due to short-term market fluctuations are key to achieving investment growth. In conclusion, through effective risk management and setting realistic investment expectations, small-scale investors can gradually achieve their financial goals while controlling losses. This requires investors to conduct thorough market research before investing, understand the risks and returns of different investment products and strategies, and develop reasonable investment plans based on their financial situation and goals. 6. Conclusion and call to action. As we come to the end of our exploration journey in this video, we've delved deep into the basic concepts of small-scale investing, its main channels, and effective investment strategies. Through logical analysis, we've learned that even with limited funds, everyone can find their place in the investment world and gradually achieve financial goals and accumulate wealth through careful planning and strategic operations. We've emphasized the importance of risk management, highlighting how strategies like diversification and dollar-cost averaging can effectively reduce risks and shield investment portfolios from unfavorable market fluctuations. At the same time, we've mentioned the necessity of setting realistic expectations, which not only helps investors face market ups and downs with peace of mind, but also ensures steady progress on the investment journey. Now, we want to issue a call to all friends who are preparing to start or are already on the journey of small-scale investing. Brave the start of your investment journey. Don't hesitate because your initial capital is limited. Remember, the most successful investors all started from the first step, gradually accumulating experience and wealth. Keep learning and adapting. The investment field is always changing, with new opportunities and challenges. Therefore, continuous learning about market trends, investment tools, and strategies, and adjusting your investment portfolio according to market conditions is crucial. Be patient and persistent. In the world of investment, patience is a virtue. Don't expect to get rich overnight. True wealth accumulation takes time. Stick to your investment plan and give it time to grow. Assess risks carefully. Understand that every investment comes with risks and learn to evaluate and manage these risks. Don't invest in products or markets you don't understand. Finally, we encourage every viewer, regardless of your investment experience, to adopt a proactive attitude and either start or continue your investment journey. Through careful and wise investment, you'll be able to create a wealthier future for yourself and your family. Thank you for watching and learning with us. Let's continue moving forward on the path of investment, exploring more possibilities, and realizing our financial dreams together.